right, good morning. Today is December 28th, 2022, and there are 3 days left, 3 trading days, I should say, left in 2022, right? Today's Wednesday. You got Wednesday, Thursday, and Friday, and of course, it's basically a holiday week. Every year, the week between Christmas and New Year is basically what I considered a holiday because most institutions are, well, I don't know. I don't know what most institutions are doing. I would say that the majority of people probably take this whole week off, right? And the liquidity is very low. If you saw today's open, you can just tell that the liquidity is very low this time of year. The volume's typically low. The market, it makes a couple of moves and then it just goes flat. Like yesterday, man, it got just really, really dull. And so there's usually a little action, a couple times during the day. Maybe some economic news comes out. I think something's coming out or something just came out here. Yeah, pending home sales down 4%. So, but anyway, typically, especially the last couple of days of the year, tomorrow and the next day, people were still in holiday mode, right? And getting ready for New Year's. The market's closed. The market was closed this past Monday. It's closed this coming Monday for New Year's. And so basically, it's a good time to just sort of reflect on the previous year and try and figure out what to expect in the new year. It's an interesting time of the year because everybody gives their predictions. I should have pulled up all the Wall Street predictions from last year because basically all the major firms blew it as far as what they expected. They all expected this year. Geez, there was some price targets over 5,000. Most of them, as you recall, the market was around 4,700, 47 something, 4,800, I think roughly was the high. This time last year, it had been going straight up all year, right? And so typically Wall Street likes to take roughly the current price and add, 8 or 10% to it and call that their prediction for the following year, as long as I can remember. CNBC's always been a constant parade of people. Now this year's a little bit different because, obviously we've had a little bit of what they call a bear market, but in most years, everybody comes on CNBC and says we expect the market to be up, 8 to 10% next year is the standard talking point. So I pulled up this little year to date. This is a year to date. Can't really see that because no, you can't. You can't see that. Here, I'll pull it down a little bit. Year to date performance, relative performance. I got this off of Finviz. This is a really cool little graph that they have. Now, of course, this is futures, right? They take all the futures and they have like a graph of how everything's performed. So as you can see, orange juice is up significantly. I guess that's because Florida got a really, really bad freeze here recently. I read something a couple years ago about how people don't drink orange juice like they used to. So I still buy it every now and then. I like orange juice, but it's not a regular thing amongst people as much as it was way back in the day. So, but anyway, the interesting thing to look at here is, and this is typically what I look at to get a gauge of, what everything's doing so far this year, especially the markets, because it's close enough. I mean, so it shows the NASDAQ 100, which would be the QQQs, down almost 33%. Wow, that's what you call a bear market. And of course, we know that a lot more of a lot of the Nasdaq stocks just been destroyed. So not just the Nasdaq 100, but if you take the Nasdaq in general, tons of stocks are down way more than 33% year to date. And also, this is just year to date. This is not how much stocks are down off of their highs. So we've looked through a lot of charts recently of high flying tech momentum stocks, and a lot of them peaked out, in last year. Yeah, last year in 2021, a lot of them hit their highs back then, and kind of provided a bit of a warning sign, I would say. But anyway, so this is just kind of fun to look at. You can see there's the Russell 2000, just down a little over 20%, officially a bear market, right? S&P 500, I don't expect any major moves in the next few days. Right now, I mean, percentage-wise, it's basically up 0.15% as I speak. And so, it could go positive, it could go negative. With the volatility we've seen recently, anything, any move that's under like a percent is almost just kind of, you can't read too much into it, because the real moves, it seems like this year, have been, the days where the market goes up or down significantly have been like 2% or more. And we've seen lots of those days. This year has been uncharacteristically volatile as far as the ranges and the daily moves. And choking on my coffee here. I'm sure you guys have probably seen statistics about the volatility that's occurred this year. You got to go way, way back, probably to like 2008 or something, to find a year where you had more days where the market moved, over 2%. So there's been a lot of crazy volatility this year, a lot of big ranges in that. It's interesting to note that the S&P is, it's not down 20%, which is official bear market territory. But obviously, at one point it was down, like 22, 23%, almost 25, if you take the intraday lows. So pretty rough year for the markets. The amazing thing is if you look up here at the Dow, the Dow has rebounded and just barely off the highs. So, 7.5% roughly. And of course, there's a handful of stocks that are holding the Dow up. And the interesting thing, and this has always been sort of fascinating, but kind of the prevailing wisdom right now, conventional wisdom, prevailing sentiment is that, the Dow stocks are like Caterpillar's up near the highs. I think, some of the other Dow stocks are doing really well, and that's sort of a perceived place for safety. I think that money just goes into the Dow as opposed to the Nasdaq, obviously, but I consider the S&P the market. The thing about the Dow is that it's price weighted, right? And that's kind of, while that's cool and everything, I think it really skews everything, because obviously, basing it on price, and we all know that, that market cap is more important than price, because, a stock could have a $1,000 price and another stock could have a $100 price, and it's all about the market cap. And so the Dow is price weighted, and I think that kind of skews things a little bit. It was interesting that Apple hit a 52-week low. I think it was a 52. It was either a year-to-date or 52-week low yesterday. And of course, everybody probably knows what's up with Tesla, right? I watched CNBC yesterday for a little while. Usually I have it on mute, but I still glance over occasionally. And man, I'll tell you what, all day long, all they talked about was Apple and Tesla all day yesterday, practically. So, it gets really monotonous. They get these guys on talking about, why Apple's gonna rebound or whatever? Is this a buying opportunity for Apple? This and that and the other thing, and the funny thing is that after watching it as long as I have, you realize that it's all the same people that, I mean, the guys that they bring on now that are extremely bullish on Apple were extremely bullish on Apple at the highs too. And so they're just like, it's all the same kind of stuff. The same people. They really ought to clean house over there because you just get tired of seeing the same people and talking about the same stocks, and I don't know, it's just tedious. But anyway, obviously that's why I have it on mute, and most of the day I'm not even looking at it, but it's interesting. So, of course, what are they talking about now? Tesla. I mean, it's their favorite thing to talk about is Apple and Tesla. And there's something else too, and this year is a good example of it, is the fad stocks, right? I mean, you remember years ago, some of you may remember when, like, GoPro was a fad stock. And amazingly enough, GoPro's still a stock, but you ought to look at the chart of it. Anyway, these fad stocks, GoPro, Peloton, I mean, there's tons and tons of them over the years, and there's always some sort of fad type thing going on, and eventually these stocks, Coinbase, Robinhood, um, just to name a few off the top of my head, I mean, which have all been destroyed. But if I had to give one piece of advice, well, actually, I give all kinds of, advice off the top of my head, and this is not financial advice. This is just, sort of market advice in general. It's that, the fad stocks always end up, eventually, they always end up, going out of favor. And so if you, and this leads to my second suggestion, and this is a great year for this idea. Whenever you got a stock, if you just happen to get lucky enough to get a stock that goes parabolic, um, you got to sell some. You got to, sell a little bit here, sell a little bit there. But when you latch on to a stock that goes ballistic to the upside, if you don't take profits along the way, eventually it's going to come right back down to earth. And I could probably show you 100 examples of that. I'm not going to, but I think you know what I mean. So I would guess that, in this whole like sort of modern philosophy amongst these young people, HODL, HODL, just keep holding, don't sell, you'll be sorry in that. I mean, it's just crazy. And then, I'm old school, obviously. I may not sound old school, but I am. And, when I got started in investing many years ago, I started off with that book, How to Make Money in Stocks by William O'Neill. And, his whole philosophy is that you never want to, you always cut your losses short at 7%. Nowadays, you see people holding stocks that are down, 30, 50, 70, 80%, right? And ARK, Kathy Wood and ARK come to mind. She's averaging down on stocks that have just been dropping and dropping, and like the biggest losers in the market are the stocks that she just continues to average down on, and that's totally diametrically opposed to the William O'Neill philosophy, the IBD philosophy. You want to buy stocks that are going up, and then when they stop going up, you have a stop loss and you cut your losses short. So, stocks are extremely volatile these days, and so maybe I think William O'Neill always said 7 to 8%. Cut your losses short. So, maybe these days you could, obviously you don't want to get stopped out of, a stock based on normal volatility and normal price fluctuation, but theoretically, yeah, I would say 10%. 10%. So anyways, if you want to look at this chart, you can pop over to FinViz and hit futures and all that, and I think you know how to get to it. But my conversation brings me to my next chart here, or my next graph, that is this. I guess this is as of the close yesterday. This is incredible, right? This is pretty amazing. I mean, look at we talked earlier in the year about how a handful of stocks, typically hold up the market, and last year it was, the mega cap stocks, the Microsoft, Apple. But look at these things. I mean, just incredible. Tesla, especially. I mean, that's the one they keep talking about. That thing's lost half its value like this month. So, pretty amazing, though. I mean, it's pretty amazing, especially something like Amazon and Disney, right? To see these stocks cut in half like this. And whoever posted this said, but the S&P is only down 20% this year, right? Which we just looked at. It's not even down 20%. It's down 18%. But pretty amazing, honestly. It's pretty interesting. And I mean, I can't explain it. I'm sure there's a reasonable explanation, because, well, I don't know. I mean, I would love to hear the explanation because, like I was just talking about, the S&P is market cap weighted, and obviously these are some of the largest market cap stocks, or they were, or they are. I don't know. But yeah, it seems interesting that these stocks could be down this much with the S&P only down, 18%. And I guess whoever wrote this um, just rounded to 20%, but pretty incredible, honestly. So, but anyway, it goes back to what I was saying, right? So, most of these stocks went pretty much parabolic last year, right? I mean, they were up huge. And, if you go back a few years, some of these stocks are actually still up. But so it just goes back to, my little piece of advice earlier. When you got a stock that goes parabolic, be sure to take some profits along the way, and, lighten up, get all your money back. And, years ago, I used to have this little strategy that we would talk about a lot here on the show many, many years back about, you know, buying a stock, setting a couple of targets, taking, partial positions off along the way if it moves in your favor, right? And reducing the average cost on your remaining shares. And so, it's kind of it's the old concept simplified as as much as possible is, if you buy a stock and it doubles and you sell half of it, then the rest of the shares are free. So it's along that sort of concept. I mean, if you buy 200 shares of a stock and then it goes up significantly and you sell 100 shares, well, now you got 100 shares and your cost and your actual out of pocket cost on it is significantly reduced. So anyway, those of you that have been around listening to the show for a decade or more, I remember, we used to do this thing, I think Wednesday nights for many years back in the day before the term podcast was even invented. We were doing a live show like this, and we used to call it our radio show, which was kind of funny, but we did an internet radio show, right? So, kind of funny, but anyway, over the years, I'm sure many of you have heard a lot of, the things that I kind of talk about now, but anyway, tough year for the market. As you can see here, there's been no hiding in the mega cap stocks, and here we are. So, let's see here. Year to date. There we go. Year to date. I always like to squeeze this in a little bit so that down here we can actually get the beginning of 2022. And interestingly enough, let's look at let's look at December of last year. The market was up here hitting all-time highs and a couple little dips, right? This and that. And then there was like this sort of tremendous run into the end of the year, right? We get it right over on the left side of the screen there. Yeah, there was like this little sort of buying frenzy. And that looks like it was, and of course, right here, this was like this week last year. The market just trapped in little tiny range up at the all-time highs, and like I always say, the last couple weeks of the year, depending on what day Christmas and New Year's falls on, it's not worth bothering with as far as like actually, doing anything. To be honest with you, I would imagine right now there's probably a little tax loss selling. This this latest sort of pullback here is probably most of the tax loss selling, if I had to guess. And now everybody's just kind of away from their desks or whatever. You can see it's a very similar sort of, just the past few days, a similar little tight range with nothing really happening as we had at the very end of last year. And that's probably because, anybody with vacation time is taking it this week. And, they're off doing something or they're stranded at an airport or whatever. And that's it. So let me try something here. Oh yeah, this is the best addition this is the best thing that's happened to stock charts all year is this little box where I can draw stuff, being able to detach it and float it, because now I can actually draw some stuff on the chart. So that trend line right there we go. Let's make it nice and thick. The thing about trend lines is I mean, a trend is a trend. It's not necessarily measured in, a pixel here, a pixel there, a poke, whatever. This was this little poke right here a couple weeks ago was kind of interesting, right? That little poke above the trend line probably, and especially after this run up and this little thing, I can't imagine that anybody decided that they were going to buy that day because, the market poked above the trend line, right? But that was all kind of based on the Fed pivot. And so, obviously everybody's aware that the Fed's raised interest rates like 25, 50, 75, 75, 75, 75, 50. So, I mean, interest rates have gone up. If you've seen those charts, I should have saved one of the charts for the show, but I mean, interest rates have increased at like the fastest pace. Not necessarily the largest increases, but the fastest pace in my lifetime. And so typically it takes 6 months for, each little increase to work its way through the system. So it's going to be interesting to see what happens next year. I can remember so much crazy stuff from this past year, like everything was about the Fed pivot, right? Well, it's priced. Everybody says that everything's priced in, and that the Fed is going to eventually, slow. First, they have to slow down. Like this whole Fed pivot thing became sort of convoluted as far as the vernacular goes, because people started talking about Fed pivot, meaning that, they did raise 75 basis points, but now they're only going to raise 50 basis points, so they're pivoting, right? And it got all convoluted, and everybody, I don't want to say everybody, but a lot of people lost track of, what a Fed pivot actually is or meant. And so a lot of hopium this year has been based on the idea that the Fed raised interest rates and the economy is going to slow down, and so much that they're going to have to lower interest rates again, right? And they keep saying over and over that they're not going to do that. They're going to hold interest rate, they're going to reach their terminal rate or something, and then they're going to hold it, probably all of next year and see what happens, because they have to kill inflation. So it's been a weird, crazy year, right? I mean, everything started with inflation sort of kicking up, and then here at the beginning of the year we had the Russia invades Ukraine, and so and persistent and rising inflation. So I mean, inflation didn't actually peak till mid-year, and even still, the Fed, I think, is concerned that even though it's come down, and so what was crazy is like this might have been this little break of the trend line, the little intraday break was when that CPI number came out, and it was only 7.7%, right? Yeah, I remember thinking to myself that it's just crazy that the market would have such a positive reaction at a 7.7% inflation rate. And so, but the thing of it is, everybody says, well, it's about the trend of inflation, right? I mean, now we've had 3 months in a row where the CPI has declined. And so it's going to be interesting to see what happens. The funny thing, a lot of this year, like 3,900 has been the big, whoop, there we go. See if I can get that at, there we go. 3,900 has been the sort of magic over and under spot for quite some time now. If you look, yeah, I guess since geez, May's like spring, right? So a good part of the year, for whatever reason, and obviously you can see some bars that kind of were right on it, like there and right around there and right here, and so I mean it's pretty easy to see looking at different days that 3,900 was indeed and still is an important level for the market. It's kind of the over under, to be honest with you. So for me, 4,000 seems like a good over under. And obviously in the new year, if the market does stage a rally in the new year, it could in theory rally up and get above 4,000 and break this trend line. So the thing of it is, and I talked about this last week too, is this entire year, I mean, literally buying just about any stock, especially individual stocks, was difficult because there was like literally like one, two, three. There was 3 rallies all year, and in order to confirm those rallies, I don't want to be redundant because I pointed this out last week, but basically, there was your first rally there, and there wasn't much to squeeze out of that as far as timing goes. So, I mean, unless we want to, typically we don't want to try and buy right near the lows. You want some confirmation that the lows are in. So you got the W pattern there. So wasn't much of a trade there. This little spot right here, there wasn't much to work with right here, right? This was a really sort of odd time. You got you got this little pattern here. Again, you got a little W pattern, and as soon as it popped out above it, it did nothing and then tanked. So that's not, I'm not even calling that a rally. This one, this August rally here, I would call it like August rally. It didn't really start till here, and so there's a few weeks of a little move up there, and that was the big fake out, like this little rally part right there. This was the huge fake out because at the time everybody's like, oh, well, the lows are in. The lows are definitely in now. And the reason is, and this cracked me up, the reason that the lows were in here, as you recall, is that no bear market has ever retraced 50% of the move and gone on to make new lows, right? that's if you go back to World War II. So there's always a little caveat. It's pretty funny that it's pretty funny how you see like these statistics on the internet or being posted or whatever. You see these stats that that started like World War II, and so I think it's hilarious because I kept seeing that everywhere, and they'd talk about it on CNBC, and somebody'd hear it, and they'd come on and like parrot it or whatever. I don't know who came up with the stat, but anyway, so in theory, well, not in theory, I mean, you know, the stock market's got more stats than Major League Baseball, right? And so they came up with a stat that said, no bear market's ever retraced 50% of the move and gone on to make new lows, is what they were saying here. They were getting everybody all bullish again, and all you had to do is draw this trend line, and of course, put a 200-day moving average on it, and literally, like, right at the very peak there, this it hit the 200-day and the trend line from underneath, and then boom, it hit a new low. And so what the caveat was that back in like 1930 something, the market did retrace 50% of its bear market move and go on to hit a new low. Right? So if you start your stats from like some arbitrary date, and of course I'm not really knocking what people do as far as publishing statistics, because obviously the market now is different than it was in the 30s or the 20s or whatever, but it's just kind of funny that was the sort of the big narrative at the time. And so, the market did go down, hit a new low. And then there was the capitulation move, right? I meant to keep this trend line at 3,900, so I didn't I was just sort of playing around there. Let me see if I can put that back at 3,900. Right now 3,900 is kind of the over under over the next few days. I mean, geez, we'd need a pretty good rally in the next few days just to get it back to 3,900. But anyway, so that was the big sell down. You probably recall way back when, sometime around this major sort of pivot low reversal. Look at the gap down that day. That 3,500 was like literally, right? Literally. Let me see if I have this on here. Fibonacci retracement. Here we go. Fibonacci retracement. This is super interesting. Let me see here. Well, no, what am I trying to do here? Well, that's not what I was trying to do. Anyways, try something else here. Anyway, this 3,500 here was, maybe I need to draw it from, well, that's not going to work either. This is one of the pitfalls of drawing stuff. There we go. Okay, this is what I was looking for. I'm confusing myself, right? So, you put this Fibonacci thing on here with all these crazy numbers, but the important thing to notice here, and I talked about this, is that 3,500 was exactly, literally about as close as it gets. 50% retracement from the pandemic low, the pandemic low bear market to the all-time high in the history of the world. You got exactly a 50% retracement, which is kind of interesting that it would be so close. And so, prior to that, people were drawing fibs on the charts from, the low to the high, anywhere along here, and saying, well, geez, if the market retraced just half of that move, it puts you at 3,500, and then lo and behold, that's exactly what happened. So that's just kind of an interesting tidbit. you know me, I'm not a huge Fibonacci fan, never have been, but I still like to draw them on there. So, this was the year of coincidences, right? This rally here in August, rallied exactly, to the pixel practically to the trend line and the 200-day moving average, which was just nuts. And, so that was quite a coincidence. And then, the subsequent low was exactly a 50% retracement. And then you started getting all this, Fed pivot talk. So that was the big narrative for the bulls all year was that the Fed's going to pivot or whatever. So, um, and interestingly enough, the market's kind of sitting here in no man's land, and it's probably going to end the year, somewhere. I would say it's going to end the year somewhere between 3,800 and 3,900. And hey, who knows? Yesterday was probably the last tax loss selling day. I don't know, maybe today is with the settlement rule or whatever, but yeah, typically, like I said earlier, the last few days just they don't mean anything. So here we are, down about roughly 18%. So the year could end up down 17% or 19% or whatever. I noticed that we've gone negative here, but we're in just this little consolidation area, kind of like here, and even a couple of days into the new year. Which theoretically this week is Santa Claus rally week, right? I mean, that's another sort of old Wall Street thing they like to throw around. Santa Claus. They start talking about the Santa Claus rally, at the beginning of December, but I believe it was what's his name, Yale Hirsch, from originally invented that sort of term or whatever from Stock Traders Almanac, and and the statistics on it are something ridiculous like the week between Christmas and New Year and the first 2 days into the year the market tends to be up 1.3%, right? And like I said earlier, I mean, a 1% move, anything less than a 1% move these days is just sort of normal price fluctuation. So I don't really read anything into a day, or a price move that's under 1%. That's just normal fluctuation because the market's been so volatile these days. So I mean, the real moves come on these long range days where the market moves like over 1%, sometimes 2.5%. So anyway, this was the huge gap up, break above the trend line, fake out day on the last CPI release, and then the following day was Chairman Powell throwing cold water on the idea that the Fed was just gonna stop raising interest rates and pivot and lower rates anytime soon, right? So I was kind of thinking, I might even said this, that they were going to raise, 50 basis points in December and then maybe go on hold and see what they think. And there's a lot of money managers out there and a lot of people I've seen articles, screaming at the top of their lungs that the Fed needs to stop right now because because of the lag effect of all these interest rate hikes. So it's going to be an interesting year. I have no idea what the market's going to do. I'm usually pretty good about inflection points. Like a lot of times, when I see an inflection point on the chart, it kind of makes sense. Like you can, like remember talking about, back over here, like there's certain inflection points, and but right now, I mean, there's no major inflection point, and this thing could go either way. But I will tell you this: in order for the market to have a big rally and a big new year in 2023 and get back to the highs, it's got to get above this trend line, right? So if it doesn't get above that trend line, then it's not going back to the highs. And it's possible it breaks above it and comes back and tests it, but so, 3,900 is kind of an important level because the market's had a lot of trouble breaking above it and holding it for too long. So as of right now, remember that everyone's optimistic going into the new year. Although this year's a little bit different because because it's a bear market, right? And so there's a lot of people that were formerly optimistic think, oh man, this thing's going a lot lower, and it could honestly things could get worse, and a lot of it has to do with what the Fed decides to do. So maybe there's one more rate hike. I think it's February. Don't quote me on that, but maybe there's one more rate hike and then they pause. But there's no the only pivot. The pivot is when things get so bad that they have to lower interest rates, and until you see the until you see the CPI or the core CPI, back to back to 2% or whatever, Fed's not going to lower rates unless something breaks. So anyway, um, I'll have more ideas once I see how the year ends, but it's just it has been a terrible year, I should say, for most investors. It's been like the worst year for a 60-40 portfolio because obviously you guys know that bonds have also been crushed this year with rising interest rates, right? So um, let's see. Yeah, there you go. I mean, there's your bond portfolio, which is supposedly the safe haven, right? And so the 60-40 portfolio hasn't had this bad of a year since probably the Great Depression or whatever. I don't know. I don't remember all these statistics, but anyways, it's bad. It's ugly, right? And so, I can remember saying at some time in the past that when interest rates are zero, there's nowhere to go but up. But anyhow, and so, here's this latest sort of rally in bonds um, is getting turned back a little bit here. So this is kind of interesting too. But that's for another time. Anyway, so there you have it. Rough year for the market. Don't read too much into the next couple of days. Um, hey, we've talked about this a gazillion times. This thing hit another low yesterday, so just all you can do is kind of look back, learn some lessons from this type of thing. One of the lessons is that when something goes parabolic, typically it doesn't end well. So I've mentioned quite a few times over the past few years that a lot of this nonsense in the market reminds me of the dot-com bubble back in the late 90s and then 2000. And so there's a lot of Nasdaq charts, a lot of stock charts out there that look exactly like the whole dot-com bubble, run up and then subsequent implosion. And so that's sort of the conundrum now is maybe we've already seen the worst of it for half the market. I mean, half the market, I don't say half of it, but a good significant portion of the market looks like this. And so it's already been decimation. And so I mean, let me just pull up Amazon here. Yeah, I mean this is kind of a good example here. I mean, this is just utter devastation. Right? When you get stocks like Amazon, companies like Amazon losing half their value or more. I mean, this thing's down over 50% from the highs, but yeah, and I mean, look where the year started here. I mean, a lot of these things peaked out in 2021, a lot of the tech stocks, but this is just utter devastation because these are buy and hold forever stocks for the institutions and the money managers and all that. So anyhow, it's been a tough year. It's been slim pickings for, buying a stock and expecting it to go up for a few weeks or a few months. So hopefully next year will be better. Um, we'll have to see. It's going to be all about first quarter earnings. That's what everybody is saying here. It's all about what earnings season looks like. So that's what everyone's looking forward to. So anyway, I will leave you with that, and I will see you back here next week in the new year. Thanks for tuning in.